Hi, everybody. Thanks for joining us. How are you, Drew?
Yes, I'm doing well. How about yourself, Deej?
Doing well.
Good, good. Happy to
Excited to
be
do this with
here.
you.
Yeah, exactly. I love it. This is going to be a really good time. And I think it's so perfectly just timed. All of this is going to be great. So,
Yeah,
yeah, happy that everybody's here.
there's always lots to talk about with the markets and the economy.
There sure is. Not a day goes by. I don't think we don't talk about it.
Drew?
Yeah. Okay. Well, shall I get started?
Yeah, let's go for it.
Let's do it. Okay. Well, again, welcome everyone. It's so great to have you here. My name is Drew. I'll just kind of be doing this presentation here as we get ready to kind of switch over here to DJ as well. So I do want to introduce DJ Wright. DJ is our director of investments, and he's a financial advisor with us here at Financial Freedom. He's been here almost 10 years. So just a little bit of knowledge there, DJ, huh?
Little bit. I've been learning, always learning,
Yeah,
never stop learning.
absolutely.
And yeah, I'm here with Drew. We've been working together for almost 3 years now. It's pretty
Hmm.
crazy. And Drew's one of our client services associates, helping take care of all of our clients. And he also is a trading assistant. So he really loves the investment side as well. So he and I kind of run the investments and make sure that we have the best for our clients.
Hmm. Yeah, thanks, Deej. So yeah, who is Financial Freedom Wealth Management Group? We are just a small piece of it, but we have a whole team here. We were founded in 2001, a comprehensive wealth management and planning firm. And that really means that if you have any issues or any troubles or just want some advice, we're great people to reach out to and have a conversation with. We serve pre-post retirees wanting to build and protect their wealth, people developing and growing wealth, as well as helping business owners who need financial services. And it's our deepest commitment to care deeply about you and your financial life, not just one, not just the other. We care about both, and it's important to us, and because we know that your finances, your life, your wealth, it matters, and we're here for that. And again, as I mentioned, we do have this whole team. I believe we are up to 20 or 21 members, I believe now. There were almost two. Not everybody is pictured here, and just because we got to get them photographed. We got to get them out here for you. So yeah, I mean, again, this team, anything that you need, we've got you. We can work with it. Any information, if somebody doesn't know, we're going to be able to find an answer for you. That's the beauty of us working as a team. We don't work individually. We work together. We think that collaboration really is the way to a better future. Um, and then also, as we go through this, because I know we're going to be covering a lot, and if you have any questions on anything that we've mentioned or other questions as well having to do with finance, the economy, anything going on, feel free to text us here at that number that you see on the screen, which is 458-777-4458. And we'll be able to answer them here at the end. And now I'm going to go ahead and pass it right over to DJ. DJ, have at it.
Thanks, Drew. Appreciate
You're
it.
welcome. Mhm.
Hard to believe we're already halfway through, more than halfway through the year. Time just keeps going faster and faster, doesn't it? But this year it's been a great year so far, another great year. Obviously last year, 2023 was phenomenal, kind of the recovery year from the bear market that we saw in 2022. And this year has been more of a continuation of that. And I think that we've exceeded everyone's expectations. When I say everyone, I mean the economists out there, people in the financial world. Nobody really thought that we'd be where we are today. And, for years now, these really smart people, these economists, that all they do is study the markets and study what's going on in the economy and try to come out to or have some kind of prediction or where we're headed. And they've been saying, recession's coming for years, and it just hasn't happened. And the stock market doesn't care what they have to say. It's very resilient, and it's been very, very strong. And I think it's a good reminder that this stuff can't be predicted. You know, nobody can predict what's going to happen with the stock market, with the economy in any given year. One thing that everybody or most of them do agree on is that long term, the markets do well, that over time, the markets are going to increase. 5 years from now, it's a really high chance that markets are higher than we are today. In 10 years, it's an even higher chance that we're significantly higher. So everybody can kind of get behind that. But the disagreement is the journey. What's the path going to look like? And so it's a good reminder that it's important to have that long-term approach with your investments. And that's how we do it. Yes, we like to look at what's going on now and all that, but knowing that you can't predict what's going to happen today, what's going to happen tomorrow. So invest with that long-term perspective. And it doesn't even have to be 10, 20 years. Long-term could be a few years. So even if you're in retirement, just kind of zooming out, not being so focused on what's happening today, knowing that over time markets do really well. That's an important reminder. So let's talk about the first half summary. Really, I mean, it's a continuation of what we saw in 2023, and all these things have just kind of continued to move in the right direction. So we've had a really resilient economic growth that has continued. The economy is growing. We are not in a recession right now. It just hasn't happened. We're seeing good GDP growth, and it's really impressive because the Fed, they raised rates to try to slow the economy down to bring inflation down. And so that's why all these economists that we were just talking about have been predicting a recession. They're basically saying there's no way we can have these higher interest rates, higher borrowing costs without slowing down the economy enough to go into a recession. And so what's really impressive is that the economy has done very well. It's been very resilient. Yes, it's slowed down a bit, but that's expected, but not to the point where we are in a widespread recession. So that has continued this year. And then we've also seen inflation continue to decrease. So last year was great. We went from 9% inflation in 2022 to now we're right around 3%. So it's trended in the right direction, and even again this year. 3% has been the historical long-term average for inflation. So we're kind of right there. The Fed still wants to get it down to that 2% target, and that's their goal. But 3% is pretty good. So because of these two pieces, because we've had a resilient economy, because inflation continues to come down, we've actually seen stock market hit all-time highs across the board. So that's happened over the last few months. You got to go back to end of 2021 before we saw, all the major indexes hitting all-time highs. So, it took a while, 2.5 years or so, but we made it. We did it. We got through it. It's never easy, but we've seen that, and that's always it makes investing easy when markets are going up. Of course, it's the down years where you can really you gotta stay disciplined. And then this last point here is market breadth still in focus. So Drew and I actually talked about this at the end of last year at our webinar, where for a while it had been those huge mega cap names, the Nvidias, the Googles, Amazons, Facebooks, Microsofts, that had been really carrying the stock market. So they were doing really, really well. And some of those smaller size companies, mid-sized companies, maybe weren't participating in the rally as much. We kind of started to see that change a little bit at the end of last year. Beginning of this year, it kind of went back to these big names. You had the whole AI boom, and NVIDIA has just been, going through the roof. What we've seen lately is kind of a shift from those big names into the smaller size companies. And that's a good thing. That's a sign of a really healthy market. And so we love to see that. That shows us that it's again not just these big companies, it's the whole market that is improving. So we're going to continue to watch that and see, if that continues, but that has been good so far this year. All right, so let's talk about the second half going forward. We have an election coming up, obviously. And so there's always going to be some concerns and people getting nervous around that. And we will address the election here in a bit. But first, we're going to take a look at some of the numbers. A lot of numbers on this slide. I'll walk you through it. So this is various economic indicators. So we've got GDP, which is gross domestic product. That's the sign of how the economy is growing. We've got unemployment rate, the CPI, which is one of your inflation readings. The PCE is another inflation reading, slightly different way to get the inflation number. Then you got your core PCE. So core basically means you're taking out energy and food. Those are really volatile prices. And so a lot of times the economists and the Fed will take those out and then look at the rest, and it kind of can give you a good indicator, maybe a better indicator of how the economy is going. And then we got the Fed funds, which is the rate that the Fed controls, and then the prime rate. So if we look over at the annual rates, we kind of just look through these, right? Look at 2021. So GDP was great in 2021. We were coming off of 2020 in the pandemic. But unemployment at 5.4%. Inflation was up around, closer to 5. And then 2022, we really saw the economy start to slow down. Remember, this is when the Fed was raising rates to slow the economy down. But we did see GDP right around 2%, unemployment at 3.6. And look at that, the CPI inflation reading at 8% in 2022. That was the highest in a long, long time. Now let's jump to that far end, our year-end estimates. So real GDP, we are still predicting a 1.8% growth. We actually had the second quarter came out, and I think it was 2.5 or 3%. It really beat expectations. So again, the economy is very resilient right now. It's doing well. Unemployment, we do expect that to go up a little bit, around 4, but still historically low for unemployment. And then our inflation, these next 3 items, the CPI, the PCE, and the core PCE, you could see all below 3%. It's kind of our forecast for the end of the year. So continuing to move towards that 2% target, moving in the right direction, still having strong economic growth. These are all positive things, and that's why we're seeing the stock market do so well. Let's talk about the current risks. There's always some risks involved, with the market. It's the way it works. And currently, one is, the potential recession. I know we've been talking about this for years, hasn't happened, but it is a possibility, still on the table, that it could happen. And so if that did happen, again, it's likely going to be mild. We wouldn't expect a really deep recession. One thing that I have heard is some people say it could be a rolling recession, which is basically means it doesn't hit every area of the economy all at once, that it hits different parts of the economy. And so, like we end of 2022 and 2023, the tech industry was laying off a lot of people. That could have been a, kind of a recession for that sector. And then, it changes to consumer spending, right? And so it could hit different areas. These are all possibilities. But remember that the stock market's always forward-looking about a year. And most recessions are, they last about less than a year on average. So if it happened, we'd kind of regroup and move on from that. Sticky inflation, if inflation started going the other way, obviously that, that would change things. We haven't seen that. We've been going in the right direction, but that's something that we need to watch out for and is a potential risk. Geopolitical stuff, there's wars going on. I think this is always a risk all the time, right? Things can happen around the world. And so that's always on the table. And then Fed rate cut timing. So the Fed had raised rates to bring inflation down. They did that. They have kind of kept rates steady for about a year now. They actually came out this morning with their decision to keep rates steady again. So no change as of this morning. Markets are expecting a potential rate cut in September. It's not a guaranteed fact. We don't know, but that's kind of the expectation. Now it's tough. The Fed's they have a tricky situation because if they cut rates, too quickly, that could cause inflation to spike again. If they're too slow with it and keep them too high for too long, that could cause, economic growth to slow down. So they have to get it right. So far, it's worked out, but this is the tough part where they start to go the other way. And, that's something that they have to get right, right? We'll see how that ends up. Now, what's going well? A lot of the stuff we've already talked about, but wanted to, if we're going to talk about risks, there's a lot that's going well, and we need to make sure we always mention that. So, decreasing inflation, we already talked about that from 9% to 3%. Very good. Resilient economy, still having good growth. That's been great. Historically low unemployment. So, around 4%, that's very good. It has ticked up a little bit, but that's expected with higher interest rates, but still very low. People that want work can find work. And then earnings growth. This is something that we'll look at a little closer here in a minute, but companies are making money. And we're actually in the middle of earnings season right now for the second quarter, and it's been pretty good. Companies are making money, and that's the backbone of the stock market growth. All the other stuff is kind of, short-term deal. If companies are making money over time, the stock market goes up and reflects that. Let's talk about the election. So it's important, and this is easier said than done, but separate your politics and your investment strategy. There's really no correlation between who's in the White House and stock market performance. And I know it's hard to do, but that is generally our recommendation to people is, got to keep those two separate. We have elections every 2 years. These things change all the time. For 100 years, we've seen the stock market go up no matter what. Yes, there's ups and downs along the way. Yes, there can be policy decisions that could have short-term effects. Companies are good at adjusting and finding ways to make money no matter who's in the White House. We don't invest in presidents. We invest in thousands of companies all over the world that, again, can find ways to make money no matter what. Here you can see, since 1926, this shows us who was in the White House and the value of the S&P 500, or the growth of $1, excuse me. And it goes up and to the right, pretty consistently. Yes, there's the ups and downs, but $1 invested in 1926 turned into about $10,000 through 2020. So again, there's limited correlation between presidents and stock market performance. You just want to stay the course and stick with your strategy, even though sometimes it's tough. All right, so this shows us the growth of 1 million. If you had a $1 million portfolio back in 1950, and that top line, the dark blue, is if you stayed invested all the way through. You put it in there and you kept it in the S&P 500. It's worth $32.5 million. Pretty good growth. The other two show you if you only invested during a specific president, party. So if you only stayed invested during the Democratic presidents, it would be 3.12 million. And if it was only for the Republican presidents, a little over 1 million. So not much growth for either of those. I get that this is a pretty extreme example. I don't think anybody is going to just only invest during one type of president, but it gets the point across that you got to stay invested through it all. Even if you were to adjust your strategy for a year, right, or a few months, that can have an effect on your outcome. So you really want to stay the course as you know, as we go through different elections and different presidents.
Yeah, isn't that old adage of time in the market beats timing the market,
There
right?
you go.
Even whether it's on that political side also.
It's such a good, yeah, it's such a good point, Drew. Yeah. And here we can kind of dial in a little bit closer of adding in who's controlling the Congress, and the average S&P 500 returns. So I won't go through each of these, but I think the most important thing here is that they're all positive, right? No matter what the setup is, no matter what the situation, the stock market's going up, right? So keep that in mind. You know, with the way we have our political system set up, you know, it's a little give and take, right? It's not, we're not going to have it our way every time, right? And that's the beauty of democracy. So you can see that some of the best returns come when we have, you know, a specific president and then a, you know, the other party controlling Congress, right? That can actually be pretty good for the markets. The poorest returns have been when one party has it all. So it's again, over time, markets do well no matter who's in the White House, no matter who controls Congress.
That's so interesting that like that bipartisanship really creates and can seems to help, at least according, to the numbers, that it seems to help the economy in that way. It's very
Right.
interesting.
Yeah, it is. It is. All right, well, let's talk about stocks and bonds here. We'll focus on stocks first. So we are in a bull market, which is where the stock market is going up, is increasing. Bear market is when we are going down. So 2022, we had the bear market that ended in October of 2022. Since then, the market's been, you know, been going up. We are approaching our second anniversary of this bull market. And if you see on that right side, you've got the bar where you can see, you know, our gains have been a little under 50%, around 50, we'll call it, so far. This shows you all the other bull markets and where we were 2 years in. You know, it's a big range, right? But if you look at the average gain, that blue line has been about 60%. So this would tell you that, yes, we've had a great run. There could be more gains ahead as we approach the second anniversary here in the middle of October. It's not a guarantee, right? But just because we've had a great run doesn't mean that we can't go any further. And then even if you take off the 2009 and the 2020, you can see those really are increasing the averages there. You know, we bounced off those lows pretty good for both those times. But if you take that out, we're still below the average. So again, when we reach all-time highs, I know sometimes investors get nervous. Oh, we're at all-time highs. We can only go down. Well, not necessarily. You know, long term, we keep hitting new highs. It's the way the stock market works. This is talking a little bit about earnings. So I mentioned this earlier, that this really is what drives stock market performance over time, is earnings. If companies are making money, stock markets go up, generally speaking. Now, again, there's psychological stuff and short-term things that can, you know, keep us off track, even if companies are maybe making money. There's also, you know, companies that are expected to make money, right, in the future can drive market performance. But generally speaking, there is a good correlation between earnings and stock market prices. And here, I mean, I like this one. You can see how much we grow, how much earnings grow. 2019, $158 per share for the S&P 500. 2020, we dropped, you know, the economy kind of slowed down. We had the pandemic. And then we got back on course, 2021, 2022, another increase, 2023, another increase. And so far this year, we're expecting about a 10% increase, you know, maybe $240 per share. Of course, we don't have the full year yet, but again, the first half has been good for earnings. And so that would be a great increase. Companies always give estimates as well as what they expect going forward. And so for 2025, we're expecting another 8% increase. $260 per share. So you can see that, we're moving forward. We're moving in the right direction. And that is a good thing for stocks. For bonds, these are great for people who are a little more conservative or people who are approaching retirement, maybe in retirement. They're living off of their money and they need some conservative investments in here. Bonds had a really tough year in 2022 as interest rates went from 0 to 5% pretty quickly. That caused bond prices to go down. And we've seen them recover a bit, not fully yet. There's likely the full recovery will be coming. As the Fed starts cutting rates, whenever that may be, that can be a positive for bonds. That can cause bond prices to go up. But I think the main thing here is that income has been the largest contributor to total returns for bonds. So with bonds, right, they pay that you get income from it. You're making loans to companies or the government and they pay you back with interest. So you get income from that. And with interest rates coming up, bonds are actually paying good income for the first time in a long time, actually. A lot of bonds out there are paying around 5%, which is great. And so, yes, there is the chance for some capital appreciation with bonds as well. As interest rates come down, you could see the price of bonds go up, which is great. But primarily focus on that income. And the income is good right now. So that, regardless of what happens with the Fed and interest rates, we know that they're paying good income and it can be a great investment for, people in retirement. And then, what we've seen lately is an inversion where, cash type investments, money markets, CDs, short-term bonds have actually been paying more than long-term bonds, which typically isn't the case. But we've seen that. You can see this here where the light blue is really short-term treasury bills. So 3-month, it's essentially cash, that's paying, 5-ish%. Whereas the bond index has been, below that. And so, a lot of people have said, you know what, I'm not going with bonds. I'm just going to get the real conservative money market CDs, real short-term stuff. I can make my 5%. And that's been great. There's nothing wrong with that. But long-term, it's usually the other way. So this is likely going to change. When the Fed does cut rates, if and when, those short-term cash type investments are going to adjust really quickly. So your money market that's paying 5%, it's going to come down as soon as the rates come down. Whereas bonds, you can kind of lock in higher interest rates if you get into those now. So it's just something to think about that, yes, cash has been great. You can make good money very conservatively there, but, we're probably near the end of that phase where, we may see that kind of get back to normal, where true bonds might pay you more than your short-term cash. Okay, so with all that, I mean, again, we've mentioned this at the beginning too, it's so important to keep a long-term strategy. There's always things happening in the world, with the news cycle these days, it's in our faces. We're always hearing about things happening all over the world, and it can cause concern and sometimes can affect investment decisions. But what we found is that, you really want to stick to your strategy, have yourself set up, know what you're investing for, know your timeline, and don't try to time things, don't try to predict, don't react to what's happening around the world. You can see here from 1970 to 2022, 10,000 turned into 2.2 million. And there was a whole lot of stuff that happened all over the world along that period. And it can cause the short-term reactions. You can see markets, go through downturns reacting to some of these things, but it's usually short-lived. If you stay the course, you're rewarded for that. And it's really hard to time things right. I understand the attempt to try to, hey, let's go to cash, let's get in at a lower point. It's just really tough to do that because, of course, we can look back and say, oh, yeah, I should have got in here and got out here. But we don't know what the next few months look like, what the next year looks like. We don't have that information. So you just want to set your account up to handle these ups and downs, which is what we do for our clients. And then stick with it. And here's our last slide. I like to end with this one, and I think this is timely right now as well. It really shows you that markets don't just go straight up. They are volatile in the short term. Um, the blue bar shows you the calendar year return for each of these years from 1980. So if you stayed invested from January 1 to December 31st, you saw the blue bar return. The orange shows you the biggest decline during that year. So usually these were pretty short-lived. You know, maybe we pulled back for a couple of weeks, and then we recover from that and move on. So if you reacted and you know, sold during these downturns, I mean, you'd experience negative returns. You wouldn't have a good experience in the stock market. But if you just stick with it, you know, you can just kind of glance through this. Most of the years are pretty good. But again, there is pullbacks along the way. It's perfectly normal and natural. It's actually part of a healthy market. You know, when we get some of these pullbacks, it's kind of like a refresher, like a resting period. Okay, we can kind of regroup here, and then we can move forward. And kind of like a professional athlete, right? They can't just perform at a high level every single day. They have to have rest periods. Sometimes they do get injured and they got to rest for that. And market's kind of similar in that way. On average, we see 3 different 5% pullbacks every year. That's on average. And we see 10%, what's called a correction every year. These are just averages. So very normal. This year, the markets have really just been going up. I think maybe we've seen a 5% pullback, maybe 1, maybe 2. We haven't seen the full 10% correction for most of the market. So again, we could see something, we could get a pullback. That's perfectly normal. We prepare for that. We set accounts up to handle that. Drew, I'll pass it back to you.
Yes. Yeah, well, thank you, DJ. Yes, so that was a whole bunch of information. Like that was wonderful. So now if you do have any questions, go ahead and text them in. We'll go ahead and go through them. You know, no question is a bad question. We're looking to help, and that's what we'd like to do is help, you know, kind of guide maybe some of the thought processes on you know, whatever issue it is that you may be asking about. So let's see. So I have, oh yes, let me talk about this as well. Our complimentary consultation. So if you'd like, you know, you're watching this webinar and you're like, wow, there's really something intriguing there. I think I could, you know, learn something, or I want to know more about financial freedom. I want to know more about DJ. Text market to 458-777-4458, and we'll go ahead and get you scheduled for your financial review. And again, that is complimentary. We want you to come in, see if we can help with that situation. And it all starts with one step. Okay. Yes. And our disclosures. These are very important. Um, you don't have, I mean, it's one of those where, hey, we've got them. We need you to know this. We need to know that, hey, there are some risks that go on with the market. So now,
Yeah, and I'll
let me,
add LPL Financial. So they're our broker, and they're one of the largest broker dealers out there. And
yeah,
you know, they kind of work behind the scenes to help us take care of our clients. So that's LPL.
perfect. Yes. So I've got a couple questions here. Let's see. We'll give those. Okay, perfect. So first one, what kinds of things do affect market growth up or down?
Mm. Yeah, and so I mean, there's a lot of different factors that go into it. As we talked about, earnings is a big one. You know, our company's growing. Are they making new products? That's going to be a big one. There can also be you know, the kind of the psychological stuff as well, right? That can play into it in the short term. You know, there can be something that happens around the world that can cause a little pullback in the short term, kind of that reaction, right? It doesn't mean that companies now suddenly aren't making money and aren't profitable, but it can cause that short-term movement. Um, so there's a lot that goes into it, right? I mean, what the Fed does can have the short-term impacts. AI, right? There was the whole AI excitement that caused markets to go up. And it's not that AI is suddenly making so much money for everybody, but it's kind of the future, right? And so there's a lot of different things at play that can affect it. But again, I think I always go back to long term, it's our companies making that, are they making money? Are they making new products? And that drives things long term.
Hmm. Okay, so next question. Is it better to have extra money, like if you have extra money, to pay on a mortgage or add it to your 401k?
That's a good one. It depends. It really depends on your situation. So we could help you talk through that. I mean, you want to look at, what your interest rate is, what's important to you, right? Is having the home paid off, or how important is that to you? And then, what do you have in your 401k currently? A lot of times if maybe you're a little behind or you don't have quite enough, it might make sense to put more into that 401k. But there could be cases where you're on a good track, and then having that mortgage paid off is important. You could throw a little extra there. So it is very situational and depends on your specific situation. So we got to talk through that and find out more about what you're dealing with and what's important to you before we could give a specific recommendation on that.
Yeah, I think that's a really good point. Is that just everybody's situation is different, and everybody's going through different periods in their life. And so that's one where I think we really do and emphasize digging in deeper, right? That's where I think we specialize in knowing you and getting to know you and your situation so that we can help you make the decisions that'll be best for you and your financial life. Got a few other things in here. Thank you for this. Feeling very reassured and optimistic. Hey, well done. We like that. Good. That's what we're here for. We want to provide that level of reassurance. That hey, we're sticking to this strategy, even when it's tough. I think that's one of those things where that's what the strategy is there for. The strategy is not always there for when it's easy. Sometimes it's there when it's difficult.
Mm-hmm.
Um, let's see, and also thank you for the political party portfolio slides. That help greatly. Happy to help. I think it's kind of cool to see that type of stuff. I would say, Deej.
Yeah, yeah. No, I'm glad. Thank you for that comment. That's
Yeah,
good.
thank you. Let's see here. We'll give it another minute or two just in case anybody has any other questions. Um, Yeah, just going back to that, I really liked that other slide that you showed, DJ, of just all the things that have happened since 1970. I think it's
Mhm.
really, I love that slide because there's so much that's always going on in the world, and it's very easy to kind of be caught in those and thinking that, oh, this is going to be the thing, that is going to hurt us, or it just shows that the economy seems to keep on going, and it's
Yeah,
really cool to see.
yeah. It's good to zoom out, right? Zoom out, think the bigger picture, and we totally understand it. It is easy to get caught up in what's happening now, and
Yeah,
fear is a real thing, and we understand that. So we're here to help, just talk through it with you, and make
absolutely.
sure you're comfortable.
Yeah. Okay. Let's see. We also I was trying to think if there was any other pieces or anything else you'd want to add here,
I
Degens.
think we're good. Looks like it's all the questions, so we'll
Okay.
go ahead and end it here. But thanks for doing it with me, Drew. That was fun, and
Oh,
thanks for everyone joining us. Hope you found it valuable, and um, have a great rest of your week.
mhm. Thanks, Deej.
Thanks. Bye.
Bye.